at NYU Stern, and delighted to be here with our illustrious panel to talk to you a bit today about preventing greenwashing in a rapidly expanding ESG market. As you all know, we have significant growth in ESG investing and in disclosures globally. We're looking at about 45 trillion in assets invested with some type of ESG screen. And we also have more than 90%, for example, of the Fortune 500 companies issuing sustainability and ESG reports. There's concerns by regulators about ESG disclosures. We're seeing more and more focus on that in the EU, for example, with non-financial disclosures. The SEC in the United States is beginning to take a look at this. So looking very much forward to hearing from our panel who represent exchanges, stock exchanges around the world to get their perspective. Our first question is about what are the best practices in preventing ESG greenwashing? I wonder if you can provide specific examples and talk a little bit about what your institution is doing. I thought we would start with Mr. Swift, who is the Chief Executive Officer of Bursa Malaysia Berhad. Welcome.
Thank you, Tensie, and a good afternoon, everyone. I think firstly, there needs to be more granularity with regards to management approach taken by relevant fund managers, as well as actual constituent companies that they invest in. Changes to respective portfolios need to be disclosed in a frequent and transparent manner. The approach taken by fund managers around sustainably related expertise and experience of the team or alternative in their assessment, is it in-sourced or outsourced? The engagement priorities of policies for climate change to tax transparency to governance issues, rather than broad sweeping statements that we sometimes see from time to time. The track record of holding companies to account when it comes to ESG issues, including voting in AGMs, is something that we're encouraging fund managers to demonstrate, and also it's something we've been engaging local institutional investors, such as Malaysia's main pension funds, EPF and Quatman. They have been doing so. To tie ESG funds on ESG indices and build on well-established transparent criteria. In Malaysia, of course, we are working with FTSE on the FTSE for Good Index. There's MSCI. I think there's a need to enhance overall credibility of claims that funds are built around ESG. There's a lot of discussion, but we need to be transparent, actually show it. Capital markets around the world, regulators, should also draw on clear guidelines as to what is rated as ESG. In a Malaysian context, our prime regulator, the Securities Commission, is working on a guiding principles of SRI taxonomy that we can all then embrace. And then that gives a confidence to the investing public and institutional investors that we are truly ESG-led.
Thank you so much. Mr. Odundo, as Chief Executive Officer of the Nairobi Securities Exchange, I wonder if you could share your perspective with us.
Yes, certainly. Thank you very much. I'm glad to be here. So from our perspective, I think we must, first of all, have this really highly driven at a national level, at a policy level, at a regulatory level, where there should be a very clear distinction between sustainable assets and what they consider non-sustainable, such that we prevent the ability for any greenwashing happening. I think policymakers should also be keen to help direct funds towards sustainable projects. We think that there's need for more rigor around regulations so that sustainable assets are very well regulated with very clear alignment to the global reporting standards and all the indicators. We also see the need for encouragement for impact investing. I think I know we are having a lot of drive from conventional investing, having an allocation for impact assets, but I think there's a need for a drive towards impact investing, and this will encourage more and more companies to come through. I think overall, it's important to have a very good ESG framework that is well aligned, more lobbying and engagement by all the stakeholders to align to this framework. And what we've done in Kenya, we did strategically set up something we called an ESG framework, a national ESG framework, under which our national issuances are being aligned to the green bonds, the sovereign green bonds, and all the assets that intend to raise are being aligned to that. And to build up to that, our companies are now all embracing integrated reporting and sustainability reporting as part of the building blocks towards enhancing and creating themselves into very ESG compliant.
Thank you so much. And Mr. Roos, Global Director of Capital Markets for the London Stock Exchange, I wonder if you could give us your perspective as well.
Thanks, Tensie, and it's a pleasure to be here this afternoon. Just picking up perhaps a little bit on what Datuk and Geoffrey are saying, I think that issuers and investors really do need clear, transparent, robust methodologies to prevent greenwashing. And I think that transparency and that spotlight is something that really is very, very critical. To make it a little bit more specific, we here at LSEG have introduced the green economy mark on our London Stock Exchange, where we've actually almost got more than 100 issuers who have signed up and who have qualified for the green economy mark. And here we use FTSE Russell's Green Revenues Data Model as the sort of underlying framework to identify companies across our market who generate more than 50% of their revenue from green environmental products and services. And I think it's that credibility that comes from a metric-based, transparent methodology backed by something like FTSE Russell that starts to give people the credibility and the confidence to know what they're investing in, which does help us a lot with respect to prevention of greenwashing. Other things like the sustainable bond market. We have a sustainable bond market where we're doing a similar type of thing. We became the first exchange in 2015 to set up a green bond segment, which allows for issuers with over 90% of green revenues to display their bonds on that segment. And again, here, we're looking for third-party reviews. We're looking for third-party verification to be provided to really increase the confidence that investors have in the robustness of those metrics and give people the incentive to sign up to and the confidence to be able to invest in it.
Thank you. So all three of you have described interesting initiatives in your countries, regions, focused on things like standards and principles and ratings. I wonder, how do we build a more collaborative, international, and cross-sectoral approach to maximize integrity during this growth phase of sustainable investing? What specific needs do you see that need to be addressed to help make your jobs easier, for example? And what type of role should exchanges play in that broader international effort? So maybe I'll start with our last speaker first. So, all right.
Yeah, well, just to sort of it's perhaps a continuation of the theme, really, in that I think that asset owners and asset managers really do need sustainable data, analytics, ratings, indices, etc., to support those investment decisions. You know, if you think about what needs need to be addressed to get that collaboration and that cross-sectoral approach working, I think that's really where the heart of it is. In terms of the role that exchanges play and the role that we play, obviously LSEG, following a recent transaction of Refinitiv, through Refinitiv, you know, we provide a huge breadth and depth of that financial data and analytics in that space. You know, we have 450 ESG metrics per company across over 10,000 companies. And I think that those data sets really provided to customers really do give them the power to do their own sustainability analysis, their own integration, and that you know, that really does proliferate across the world and allow for that allow for that confidence. So I think, you know, that's the area that we're taking. You know, FTSE Russell as well, one of the other divisions of our business, offers sustainability analytics on fixed income, you know, incorporating our beyond ratings analytics, and so that approach in calculating, generating, and disseminating analytics data to people across the world is something that is the role that we're playing in that space.
Thank you very much. Datuk, what is your perspective on how we build this collaborative international endeavor, as well as the role of your exchange in that?
Thanks, Tensie. I mean, building on what Mario was sharing, I think that the primary issue at the moment is there are so many different products, be it equities, securities, debt, claiming to be green. But are they truly green? And how do we define green? And the exchange, what we work towards at the moment is actually driving common by asset class, by investor class, and reaching out to investors. What is it they want to see as a basic? So even before applying analytics to it, what is the real information they need to make an informed decision to decide whether that asset is green or not? Now, as we go around the globe and capital has no barriers these days, we actually need to have a common language that is over and above. And I would like to see, there's various initiatives to see congruence amongst different platforms. And at the exchange, we are working towards very much at Bursa, we're a part of that and trying to get a common language between all our exchanges around the world. Of course, working with our friends at FTSE Russell. But more importantly, I think the key thing is, going beyond that, is the taxonomy that is consistent. So there's also been some discussion, developing market versus mature market, where does it sit, what are the key drivers? And I think this is something we need to, at exchange level, we need all to work together and actually engage our institutional investors, because rewarding good conduct, people who are truly green will then embed it and become more and more of what we want to see.
Thank you. Geoffrey, same question to you, and also I think your perspective on this question that Datuk raised around emerging economies and the approach there would be very helpful as well.
So the ESG is now gaining currency in the frontier markets as well, especially Africa. And what we've done, especially at the Pan-African level, first of all, is to get the exchanges to align to the UN SDG goals through our membership on the US Sustainable Stock Exchange Initiative. And so we have an association in the African continent and have set up a dedicated committee that drives our sustainability agenda. And so across all exchanges, we are trying to standardize our issuance regulations, our guidelines, so that issuers in the respective exchanges clearly understand how to guide their clients when they're placing all these requests coming through. At a very national level, our government is setting up ESG guide frameworks for issuance of, for instance, a green as sovereign bond, well aligned to all the international standards and guidelines. But even before we rush into that, we are getting all the experts in to ensure that we are issuing, we are creating an issuance that will meet international standards. At a very practical level, one of our companies was able to issue a green bond last year, and it was dual listed in Nairobi and London. And a lot of input came from our friends in London, from a knowledge share perspective, structure, ratings, guidelines, and that has ensured the success of this issuer that is now going into a third round of capital raise based on that knowledge. So I think it's important to share knowledge, partnerships, and really collaborations to ensure that other regions are able to increasingly get into that. I also want to support data. I think the sustainability exchange indices and as much data is necessary for us to really be able to create products that are really viable and will get rid of the greenwashing that currently takes place.
Thank you so much. It's really clear that for all three of you, ESG is becoming very central to the work that you're doing. And I'm wondering, if you use your crystal ball looking forward, how do you think the field will have evolved in 5 years? And what do issuers and investors need to do now to prepare for those changes from your perspective? And Geoffrey, maybe I'll start with you.
I think the realization that good ESG provides very, very good insights towards good investments and good practices is becoming a very exciting trend across all fund managers and across all asset classes. So what I see in the future is that a lot of issuers will really be coming out with a specific allocation of assets that are basically clearly green. Investors are looking for conventional investors also transitioning a bit more of their allocation to green. And I see that becoming the currency. I see a lot of companies on our exchanges adopting integrated reporting and sustainability reporting, because the questions being asked by all investors is, despite the returns you give, how well are you running your business? So my crystal ball view of the future is that most of our issuers, most of the issuers are going to really adapt to these frameworks, and we'll see more and more green products coming through to the market.
Thank you. Datuk, what about your crystal ball?
I echo Geoffrey. Tensie, at the end of the day, issuers are being told you need to be sustainable. Now, the call to action in our market for the large corporates, they've already embraced integrated reporting. They're making the necessary disclosures. I'm afraid to say I have a middle market that is yet to embrace. And so at the exchange, for those seeking capital in that middle market segment, they need to see sustainability become embedded and move from being in the minds. How does one put it? This is probably not quite de rigueur, but if you're an independent director on a small listed PLC, you may view sustainability as a cost rather than an investment for the future to build your business. You'll just see the bottom, you'll be seeing the impact of bottom line, but not the long-term top line. But as consumers and customers and investors make that demand, in 5 years' time, you'll need to be well placed. We see our institutional investors already leading the way, making specific allocations for green investments, shying away from brown investments. Of course, interesting conversations about stranded assets, what are we going to do, and so on. And then I think that's going to be the key. And then what we'll see is greater disclosure, and not only just disclosure, but I think we're going to see third-party verification of said disclosure also in the next 5 years. But that third-party verification will now be at a price point that is acceptable to the majority of the market and will most likely be provided by international service providers. So across the whole value chain, you'll be able to see who you're buying from, are they green or not, and you have provenance, and so consumers will be satisfied.
Thank you. Murray, how about you?
Thanks, Tensie. I'm going to go out on a limb here. In terms of the growth of ESG as a market, and you referenced the amount of assets that are following ESG in some way at the moment, I think we are going to see the rate of that increase even stronger over the next 5 years. And so I think 5 years from now, we see a world where we have real dominance of the ESG agenda in the asset management industry. And I think that both issuers and investors really do need to prepare for that, what I see is for that eventuality. I think we're well past the tipping point of understanding the actual importance of ESG from an investor's perspective and from an issuer's perspective. And I think that acceleration is really happening. From investors' perspective, back to data, back to analytics, back to understanding what you're buying, how it impacts things, and really being educated on how you're spending your investment dollars. And then for issuers, I think it's really important to encourage improved company disclosure. You know, we at LSEG have been a strong supporter of TCFD since its start. You know, following that call to action last year between Mark Carney and David Schwimmer, all the CEOs of the largest exchanges globally, we've convened a coalition of over 20 exchanges to try and develop consistent reporting guidance based on TCFD. And I think that that is going to continue to grow. We're going to continue to get that cross geographical consistency of standards, which will fuel that further. And I think 5 years from now, the world will be a very, very different place, driven by the actions of issuers and the voting power of investors.
Thank you. The last few minutes, I have a question. So we've done some research. We just published a meta-analysis looking at the last 5 years of academic research, about 1,200 different studies, looking at the correlation between financial performance and ESG. And what we found pretty consistently was on the corporate side as well as on the investor side, you saw outperformance, or at least as you know, performing alongside of conventional investing, for example. We saw very few studies that found a negative correlation, but this is still an ongoing conversation, and I just wonder if anybody has any perspective on that question of performance through your own experience, and we'll just open up to anybody who'd like to jump in.
Well, Tensie, perhaps I could jump in and offer something to kick out to the group to start. I think that it's interesting, the correlation between longer term performance and ESG, I think, is becoming more and more broadly accepted. What you're referring to about that concern about making those ESG investments is, to my mind, perhaps a little bit less about ESG versus non-ESG as it is about short-term versus long-term. Because we know that frequently we have a short-term investment that needs to be made for long-term gain. And that conundrum in management teams is something that I think is not very well handled across the board, be it ESG or technology overhaul. And I think that quite a lot of the time we have negativity around ESG, the genesis of it is actually in that short-term, long-term thinking.
Thank
I think
you.
I'll only just throw a few seconds out this. What we've seen in our country is that there's a strong correlation actually between good performance and good ESG adoption. Companies that have investors are looking for companies that have good governance, a strong independent director framework, and that's contributing a lot to a positive performance of companies. So there's more and more adoption and appreciation of ESG to drive performance.
Thank you. Datuk, quick.
Clearly, at the end of the day, governance was the shift that was moving the dial before. We're now moving to sustainability. But I think Murray has hit the nail on the head. It's short-termism versus long-term investing. That's the greatest challenge for our board as they start this journey and navigate sustainability. So, dear investors who are on the call, please think long-term and support companies who are doing the right thing for the future.
Thank you so much, everybody. Really appreciate your time, perspectives, and insights, as I'm sure the audience has. And many thanks again to the Institute for bringing us all together. Thank you so much.
Cheers.
Thank you. Bye-bye.
Thank you.
Bye-bye.
And a big thanks to Tensie Whelan from NYU and indeed that panel. They're really looking at the prospects of avoiding greenwashing and the great prospects that there are out there. And I think you really heard it there. We heard from Murray at the LSE, or at the London Stock Exchange Group, very much talking about that tipping point has actually happened. And when we look to the longer term, we look to 5 years from now, we're going to see a very, very different environment. So I think there was out of that too a big call to action to say to people, this is happening, this is real, and actually move forward to it. So again, exciting delivery from all of our panel there, and really looking at maximizing market integrity and moving forward. So we're going to carry on. We have another panel, and we're going to look now at the measure of success. And Sarah Cocker is back with us, so I'm going to pass it over to her with her final guest for the day. Sarah.